Hello and welcome to an additional video about forward testing. What is forward testing? Well, forward testing is, as you started earlier, I saw earlier this week, that we ran the scanner in the open market and we ended up picking up VST, MRK, and AMC. That's what forward testing is. You run your scanner, and then from your scanner results, go to the chart and then mark up the chart, and then keep a list of what you did, and then come back and look at it in a week's time and see how did the scanner produce a winner for you, and would the trade would have been profitable. This is a way of testing a trading strategy before you go head in to dive head first into the shallow end of the pool. Don't. It hurts. So what you do is forward testing is just go ahead and mark up the chart and then come back. So earlier this week, we had VST pop up. Now I'm going to go one step further. Now, one step further, did VST would have qualified for an options trade? I didn't do that. I was just checking again. When you're checking for a strategy for foundation, you could go the extra step and say, does it qualify in the options also? Because they're two different things. One, we're qualifying the price action off the stock, and then we're qualifying to see if the option has enough liquidity, open interest, and if the ask bid spread is bigger or less than 10% to take the trade. And here we're going to go. So Vista, right there, Vista right here. First one, we'll use this as an example. It's a small account. I do 10% allocation for under 25,000. Why? Because I want the account to grow fast as possible to eventually be able to get into some better trades, and then at 5% above 25,000. But again, that's another key point too. The more trades you put on, the more time you're gonna have to need it to take care of that. It's like having a garden. If you start growing one vegetable and then you grow 5 or 6 or 7 vegetables, all of them need care. So the point will be is that we're using this as an example. 10% is 558, and then divide that by 100, it comes out to 5.58. That's how I'm able to say, okay, my budget is only 5.58. But look here, everything was under 5.58 for VIST and VIST, and this was a 20-cent spread. That's really very good. It's almost 5%. That's kind of cool. This is only 20% off. This is 20 cents also. Remember, I'm looking at the bid, the ask minus the bid. How do I get that 20 cents? Easy. Minus 370 from 390, 20 cents. $3 from 320, 20 cents. 235 from 250, 15 cents. So now you would be able to say, okay, so now you can also look at the delta. When you're looking at delta, you want to look at the probability. The probability is another qualifier too, is the open interest. You want to have at least over 5,000 open interest on both sides total, from both sides of the aisle, from the puts and from the calls, and it's definitely qualified just by itself on the call side. So this is a very good. This trade would have been very option qualified. That's what I'm coming down to. Now, the risk taker who will do one out of the money right here, 150 divided into 558. So now how you determine the number of contracts? Well, the number of contracts is you have 558 allocation, and let's say that you're going to be a bit of a risk taker, and this 15 cents, that 10 cents is very borderline. I really don't care for that. But the one out of the money trader is going to say, you know what, I am not going to give the market any more, and I'm going to stick to one out of the money. Okay, no problem. So 150, because remember, one contract is 100. Divide that, $1.50 is actually 150, and it comes up to 3 contracts. So now that's how you get your risk management. 3 contracts right there, keeping it within your 10% allocation. And then going up the scale for the more moderate trader, they would go to the 195. Again, this is 15 cents, and that's way under the 10 cents rule. That's cool, 10% rule. 558 divided by 195, the anticipated entry or the option. And this all, you're going to have slippage. It will happen. But right here, the whole number. Options cannot be broken down in portions. So the whole number is 2. You round down. And of course, all these guys, all of these would be one contract right in here. And then the more alternative conservative trader would be up here at the 70, would be here at the 73 or the 80 delta. So that's how we do risk management. And that's how we determine the number of contracts. So that said, let's go on now to Merck, who also popped up on the screen of this earlier this week. and MRK is right here. And there's MRK. Now we'll go ahead and look and see, do we have any qual? Well, right there. Right, again, one out of the money. This is 27 cents, and the spread is 9 cents. 9 cents spread here. This would definitely be in the wheelhouse of the one out of the money trader, and that would be one contract, and it's only 275. Then the more moderate trader will be here at 410, be one contract, 15 cents again. Then the more conservative trader will be up in here. And again, you got to keep an eye on your budget. So right there, the moderate trader would be able to get this trade, but this one would not be qualifying under the budget rules. Now, if this is larger account, then it would count. So that's how we do it. 10% of capital, 558, divide that by 100, makes it, the option should not be more than 558, and bada boom, right there. And that's where the risk management will come and control the account to avoid getting into any danger. All right, so that MRK passed pretty good. Let's go on now to AMC. That was our other one that came up on the scanner this past week. And you see that the order now, you have to make sure that the order doesn't trigger. One other, remember the rules. Stochastics trading. If the order doesn't trigger, cancel the order and then do the scan fresh. Do not carry over a trade that does not trigger. Let the scanner find fresh stuff for you. But now look at the budget. It definitely will not qualify. One out of the money would have been $13.50. Now there is another kind of trader. Who that other kind of trader is? That other kind of trader, we have to look at the open. Oh, we have over 5,000, so we did good. Got 2 here, we got 4K, 2K here. The other kind of trader is your Delta 30 trader. Yes, they are traders who will do in the low deltas, and right there. So 558 right there at 30 cents right there. There's your 30 delta trade right there. 35 delta, 551 contract. And why did they do that? They do that because it's like surfing. Trading is surfing. You don't know which one's going to take off, and you're going to be there when it happens, but you want to be there with the restraints and controls that you don't blow out your account. So MRK we would have had MRK here at the 550 for the 30 delta traders. So we have covered the 30 delta trader, one out of money trader, and then the moderate traders and the conservative traders who have that kind of money to buy that option. Going on now to our last one of today, and this popped up in today's scan, and that's EWT. EWT is the ETF for Taiwan. So now we're looking here, and we're going to see, and I always start off with the 8. I like to stay around par if possible. Okay, so right there, your 30 delta trader would be right here, and you still have to use the 10% rule. So this is 25 cents. This would disqualify. The 30 delta would not be taking this trade because it's more than that 10%. The ask is 205, the bid is 180. That's 25 cents, and you only allow 20 cents. So that's out. This is 20 cents. So this one would qualify. So the 30 delta would move up here until he finds that trade, and then the 30 delta would take that or pass up the trade. It all depends upon their risk tolerance. One out of the money is 50 cents, disqualified, done. The moderate trader is running here at 60 cents, doesn't qualify, done. 10 here at the 56 delta, that almost qualifies. Again, it's right on the very edge. This is not the qualified, and this one here is running 50 cents. That would be the qualifier there for the conservative trader at 65 delta. And that would have been our entry right here at the top of this candle and the swing low right here. Well, and that is a quick review of forward testing, and that's what forward testing is about. And you can come back and check your results day to day, or let it go and put it away and come back in a week. But that gives you a good fundamentals of how to come up with a trading plan, come up with a scanner, go and do it, and then mark up the charts. Don't put any money into it until you are satisfied that it's going to work. And with that said, I say thank you very much for stopping by and checking it out.